Good morning, good afternoon, good evening, depending on which part of the world you are in. Welcome to this very interesting webinar we have today on Credit Risk Management 4.0, balancing the needs of volume, speed, quality, and compliance. We have a very interesting, eminent panelist today. This webinar being hosted by IBSI and sponsored by SG NewTech. We have with us, in the panel today, Anuj Mediratta. He's a deputy CEO. He's the head of banking at Gulf African Bank in Kenya. He's worked with over many years. He's worked with Barclays and Standard Chartered and across Kenya, Tanzania, Nigeria. Seasoned corporate investment banker, chartered accountant, and more importantly, a client of ours. So welcome on board, Anuj. We have with us Apollo Ongara.
Thank you, Ram.
Apollo, as many of the people in the audience would recognize, he was ex-credit director at Kenya Commercial Bank. And prior to that, Apollo used to be heading credit at KCB Tanzania. Many years, maybe 30 plus years in the industry. Apollo, he has a degree in economics and business admin from Kenyatta University, and he is an associate of the Chartered Institute of Bankers in London. Apollo, it's a pleasure and a privilege to have you here with us.
Thank you.
May I also welcome Tunde. Tunde is the chief executive and founder at SG NewTech. It's a very interesting career, I must tell the audience here, Tunde, with your permission. He started his career as a banker with United Bank of Africa, if I'm not wrong. He's worn multiple hats. With both banking and technology, he started with global technology, and then he founded a company, Delisys Delivery Systems. He was a CEO till his recent stint as the CEO for SoftGen Africa, till he founded, and he's now the chief executive of SG NewTech. Tunde is he had his first degree in computer science. He's an MBA graduate and also done an advanced management program with EISC Barcelona. Moderating this panel is yours truly, Ram. I am a senior partner with Cedar. Cedar Consulting is the parent firm of IBS Intelligence, the host of today's webinar. I lead the financial services practice, been in the industry for 28 odd years. And more importantly, looking forward to a very interesting discussion on a topic that I guess most of you in the audience are raring to, and waiting to hear what people have to say here. Quick introduction about the structure of today's discussion. We would start the discussion today with a quick poll, which we will obviously have our people in the audience poll. And you would be, to make sure that you are staying awake and staying along with us, we will be polling you periodically. And then we will obviously start with an introductory presentation that Tunde would like to make. Post which we will jump into a very interesting executive discussion, with the panelists who are here with us. And after that, we would be opening up, for audience Q&A. So please feel free to post your questions. You have a Q&A button on your screen. You can pose your questions to us, and we'll do our best to answer them as we move along, but certainly towards the end when we have a reserve session there. So with that, if I may jump into the first poll for the day. And since we have a very interesting topic today, why don't we start with something that is aligned with the topic? A small secret, if I can share with all our audience here. The panelists do not know these poll questions themselves, and they are also going to be polling along with you. So let's see what the answers are. Anuj, could you see the screen? Can you see the poll questions?
Yes, I can.
Okay, excellent. So your time starts now, everyone. You can start polling. So what, in your own view, is the biggest challenge in credit risk management? Is it dealing with the volatility of credit volumes? Is it delivering on turnaround times and protecting customer experience? Is it about alignment of policy and process in ensuring credit quality? Or is it keeping pace with the emerging compliance needs? We obviously had a very interesting topic today. And the whole topic today was about balancing the needs of volume, speed, quality, and compliance. So let's see which of these three takes the lion's share. 30 seconds more and we'll close the poll. So while we are waiting here, maybe Tunde, I will, if I may actually ask you to share with us what would have your choice been, if I may.
Yes, Anuj, can you hear me?
Yes, we can hear you Tunde.
Right. So you're asking for the what I selected in the poll.
Yeah, yes. If it's a secret, you can hold it, no problem. But
yeah. No, I have selected the need for meeting the regulatory compliance requirements, right, as my choice, as the biggest challenge that is faced by institutions.
Interesting. Well, I'm concluding the poll just now, and I'll quickly publish the results. Now, well, a good 23% of people thought the way you chose Tunde, but looks like almost half the population believe that the biggest challenge area in credit risk management seems to be credit quality. And how do we ensure credit quality, be it in terms of alignment of your policy norms or your processes? Well, I mean, on that note, if I may invite you, Tunde, to share with us your thoughts on this topic today, and then we will continue our conversation. Tunde, over to you.
Okay, just sharing my screen. Give me a moment. Okay, thank you, Ram, for the introduction, and I'm pleased and delighted to welcome our participants to this session, to this webinar. The title is Credit Risk Management 4.0, Balancing the Needs of Volume, Speed, Quality, and Compliance. As you would agree, this is a very topical issue with banks today. And banks are looking for ways by which they would meet the challenges that is presented in the area of credit risk management. But before I dive into it, I'll tell you a little bit about Software Group. We are a global technology company that focuses on helping banks and financial institutions to digitalize and to integrate their technology platform. We operate out of 9 offices represented in different corners of the globe. We have delivered over different projects in over 70 countries, spread across different continents, and we employ over 350 experts globally who provide quality services to our customers. Now, going to the topic of the day, banks or bank executives, bank directors, they have to fulfill a dual mandate. One of the mandates is for them to achieve continuously market-beating growth. And at the same time, they're expected to do this not necessarily expose the institution to risk. If you look at these objectives, it's a conflicting objective in one way. However, lending itself, is a risky business, and banks have to lend in order for them to survive. So how do banks respond to this? Banks respond to this by evolving methods by which they will manage the risk that is presented to them in the area of credit. So I'll take the next 10 minutes basically taking you through what exactly does credit risk management mean, and what are the challenges to effective credit risk management. We'll also talk very briefly about the best practices or the best practice that we found in the area of credit risk management. And then finally, I'll talk about Credit Quest, the solution that Software Group offers that empowers banks and financial institutions to meet some of these challenges. So credit risk in itself refers to the probability of loss due to a borrower's failure to make payments on any type of credit. If this is the case, then credit risk management will be the methods, the ways that have been involved by banks to mitigate losses by understanding the adequacy of banks' capital and loan loss at any given time. Since the global financial crisis, regulators have started demanding more transparency from financial institutions. Regulators want to understand that banks know the customers that they are dealing with, whether it is individual customers or business customers. And regulators want to ensure that banks stays abreast in terms of what is happening to the credit that they have granted to various businesses or various customers. So banks are in the middle of different stages of overhauling their credit process. Some of these institutions have seen it as a means to meet regulatory requirements, but other banks have equally seen in this an opportunity to greatly improve on the overall performance of the business and actually secure a competitive advantage. My personal opinion is that any bank that sees this only as a compliance exercise will be short-sighted. I think the way to embrace this is to see it as a means not only to meet the regulatory compliance requirement, but equally to improve the bottom line of the institution. Now, what are the challenges to effective credit risk management? From what we have seen in the market, insufficient data is probably one of the big issues that is faced by credit analysts and credit decision makers in different institutions across various continents. There are still countries across the globe where it is difficult to uniquely identify borrowers because they do not have a national ID scheme. Or you may not even be able to uniquely identify where a borrower lives because there is no such data available in the country. Similarly, when you lend to the SME space, it is very difficult to get data from SMEs. And even when you have the data, the reliability of the data, cannot be trusted. So this is one big challenge that we find facing effective credit risk management. Now let's move to the next place where you actually do have the data. However, it's common practice that banks will have different systems, disparate systems, for different aspects of credit. So you go into a bank, you say they have a different system for credit card loans, a different system for their corporate loans, a different system for their mortgage loans. What does this mean? You've got data quite all right, but this data sits in silos. And for you to be able to gain insights, you have to do a lot of heavy lifting, to aggregate this data and be able to see what your customers are doing. So this presents a challenge. And in certain instances, you actually have customer data sitting on the Excel sheet, of various credit analysts within the bank. This does not help the cause of effective credit risk management. In addition to that, most banks do have credit policies, but these policies are left to be implemented manually. And when you implement processes or policies manually, it is difficult to know whether it is being applied across board uniformly. So where you would leave this to be, implemented manually, you face a situation whereby there are no standard processes within your organization. And finally, another challenge that we've seen is inability to define and to monitor early warning signs that you see within your portfolio. Experts believe that before a loan goes bad, there are usually early warning signs. It could simply be that the first missed payment could be an early warning sign. But the question is, do banks actually have coherent ways of identifying these early warning signs in time, so that they can take proper action? Another common, early warning signs are covenants. So if there is a missed covenant, do banks actually have a mechanism to know that a covenant has been breached and some action needs to be taken? Now, moving on to the best practice that we've seen in credit risk management. One of the key practices that exists in the market is to gain a complete understanding of the bank's overall credit risk, not only at individual level, and by individual, I'm talking about individual customers and business customers, but also to be able to gain understanding of the overall credit risk at the portfolio level. And getting insight at portfolio level means that being able to bring all of the data from the different segments together and actually being able to see where does your portfolio lie. Are you overextended in a particular sector over others, and being able to level things out. Second is also the fact that you need to be able to bring your data from the disparate systems that you have and actually implement an integrated quantitative solution that actually keeps your data not in silos, but within a collaborative, unified environment. This is the way to gain access to insight and be able to know where your portfolio stands at any point in time. And this is where Credit Quest actually comes in. Credit Quest is actually a system that has empowered a number of institutions in different corners of the globe to bring together all the elements that make for effective credit risk management. So whether it is your loan origination, or whether it is the workflow that implements the policies, or the appraisal, or your document management, Credit Quest actually allows you to do this within a streamlined solution, a centralized database, and also integrates easily with your core system and any additional data sources that you may have. And banks that have implemented Credit Quest have managed to achieve huge impact as displayed on the screen. 80% reduction in turnaround time, higher productivity, growth in credit portfolio, as well as gains in cost savings. And all of this put together brings about high quality credit portfolio. Now, how does Credit Quest do this? Credit Quest does this by basically mapping the different stages that you have in your credit origination and credit appraisal processes. So there is a component called Credit Manager that actually presents you with a tool to automate your policy. And once you automate this policy, it ensures that the policies are applied uniformly by all the credit officers as well as credit analysts. This is where you do your document management. This is where you capture information about your collaterals. This is where you define the different covenants that you want to observe within the credit process. In addition to that, there's a second component of Credit Quest that is called Financial Analyzer. And with Financial Analyzer, this is where you spread your financial statement, you compute the ratio that are relevant to the credit type that is being appraised. This is where you do your projections. This is where you do your peer group analysis. And this is where you also define your financial covenants. So for example, you want a particular ratio to be monitored. And every time the borrower presents the financial statement, you want to ensure that that covenant has not been breached. Another component is Rating Manager, which is our multi-dimensional rating engine. And with Rating Manager, Credit Quest allows you to have various types of rating engines. For example, you could decide that for a particular loan type, you only want to use demographics information. This you can do within Credit Quest. For another loan type, you may decide to use the demographics information and perhaps data from external source like a credit reference bureau. With Rating Manager, you can do this. For your corporate customers, your decision may be that you're going to use demographics data of the directors of the business together with the financial statements and the financial ratio that you computed. Rating Manager allows you to do all this. Report Manager obviously is important. This is where you generate reports about the individual loans as well as monitor the turnaround time of your loan processes. Finally, you've got portfolio manager, which is where you see analytics about your portfolio, your credit concentration, your exposure, who is the largest borrower or the largest term borrower, or whatever additional analytics that you might want to get out of the system. CreditQuest recognizes that today, you do not want to originate loans only from the branch. You want to originate loans from channels. Could be your internet channel or mobile channel or any other channel, or even your partner channel. It could be a car dealership or whoever you have partnered with. So CreditQuest gives you the tool to speak to the outside world. And this outside world could be channels. It could be additional data sources. It could be your host system or your core banking system, so that the loan management activity can take place. So from all this, you can see that CreditQuest indeed covers all of your need end to end, enables you to manage the life cycle of your credit, and gives you quality insight as to what is going on. Now, whether this is credit card loans, or it is consumer loans, or it is corporate loans or SME loans, you have one system that manages all of your loans and keeps your data in one database, not in siloed databases. Banks that have implemented CreditQuest have been able to derive the following benefits. As a result of the automation of the credit process, they have achieved improved turnaround time. Similarly, they have healthier credit portfolio because they are adhering to the credit policy, and they've standardized the workflow, and that everybody follows the same process that has been defined in the system. Because you're working off one database, you actually do have a unified view of all of your relationship. And finally, all of your credit types sit in one database, meaning that if you have an individual customer who has a mortgage and who also happens to be a director in one of your business customers, you're able to actually see the overall exposure to that individual. The next slide, which is going to be my final slide, actually talks about some of the institutions globally that have empowered their business using CreditQuest. Starting with a Wall Street giant, just such as JP Morgan Chase, where they use CreditQuest, for all of the corporate credits. You also have Gulf African Bank, which is the premier Sharia compliant bank in Kenya, have equally implemented CreditQuest. You also have a regional bank with subsidiaries across East Africa, KCB, where CreditQuest has been in use for several years, and this is actually what powers their credit process. Similarly, you have small microfinance institutions, such as Rafiki Microfinance Bank that's equally implemented CreditQuest. And finally, you've got specialized financial institutions, such as TDB, that's Trade and Development Bank, which is a development finance institution, also using CreditQuest to power the credit process and to achieve optimal credit risk management. So in conclusion, my question to you, the audience, is are you interested in meeting compliance requirements of your regulators? And are you also interested in improving the quality of the loan portfolio that your organization has? Are you interested in improving the turnaround time? Are you interested in also growing your portfolio? If yes, the answers to these questions, I'll say that CreditQuest is probably the right solution for you to consider. Thank you for listening. Over to you, Ram.
Obviously, a very interesting presentation. Maybe you can stop sharing your screen so we can all be visible on full size. So while we are waiting, why don't I start with the next poll, which is on the lines of what we are going to talk during the discussion today. And the question goes, and you can see it there, what in your view is the key credit risk factor that has been most impacted in the last 2 years, right? Is it the non-alignment of revenue and cash flow because of the COVID? Cash flows have all gone for a toss. Is it poor planning between short and long-term funding? What you thought was short is becoming long and vice versa. Is it the disruption that we're seeing into the working capital cycles? Or is it the economy challenges and resultant unemployment, right? So, of course, the poll is on now. And while we are waiting for the results there, Apollo, I mean, you've obviously been seeing the industry and you've seen the whole disruption happening out there. You have a view on this.
Yes, thank you, Ram. What I can say is that I would score economy as the most impactful in the last 2 years. Of course, we are all aware about the effects of COVID. And with it, last year, we saw economies worldwide tumbling. So if you look at sectors such as travel, hospitality, and the likes, they felt the most strain. Yeah, so unemployment levels are high. So all of it comes to show in the financial institutions ultimately. Yeah.
Well, let's see what the audience have to say. And no surprises there. They seem to concur completely with you, Apollo. I think the economy challenges and the resultant unemployment seems to be the one key credit risk factor that people see as actually having impacted the most in the last 2 years. So with that, I'll probably start the discussion session and we'll keep it, maybe a little bit of a round robin, if you like. And maybe I'll start with you, Anuj. And I think the fact is that we have seen credit as the credit assessment itself as a science evolving, right, in the last 5 years. And we saw Tunde present today about how increased access to data and analytics is all helping in real-time decision-making tools. How do you see this whole evolution in the last, let's say, 3 to 5 years?
Absolutely, Ram. A fantastic question. And I think the last 2 years have taught us a lot about what we thought was going to happen and what actually happened. From the times when clients could not walk into banks, people had to be segregated and business had to continue. So I think, the digital era had to step up and banks had to adopt on that side. And if you look at the credit side of it, in the last 5 years, banks are looking more and more at data and scoring models to ensure that, we are agile and able to produce much better results much quicker as the client becomes more demanding and wants answers at the click of a button. So, that's changed the way banks have done things. The other thing is banks have adopted a lot of artificial intelligence and started using alternate sources of data. If we looked at maybe a few years ago, I can speak for Kenya in particular, because it's quite a well digitally penetrated market. The underbanked, the unbanked did not have access to funding. The person on the street, the MSMEs, and obviously people had to come up with new ways of working and getting that sector of the market banked. So, today they can borrow money at the click of a button. They may not be able to read and write, but they know how to borrow money from their phone. So, how can banks develop and access all this data that's out there to ensure we're able to provide information and data approvals on a real-time basis? The other thing is, which comes along with that, is straight-through processing. There are multiple sources of data. So how are banks able to cover that in a very short time, get their ratios right, debt to income, loan to value, credit worthiness of applicants, and be able to satisfy the client's needs while protecting the bank's interests in a very, very short period of time. So things have been changing. However, I see this speed as a double-edged sword. because along with it comes over borrowing. People who don't have financial discipline are suddenly at the mercy of all these apps. They are into triple-digit interest rates, which it is questionable whether you're actually alleviating them from poverty or driving them into further poverty. So, like I said, it's a double-edged sword. People over-leverage, borrow at very high rates, although they have access to the funding.
Well, thanks for that, Anuj. And I guess, as they say, every progress is obviously, it's a double-edged sword. But, if I was to just shift gears to Apollo and actually, go back to the point that Anuj was making, right? How does one draw the line, right? On the one hand, you have these automation-driven credit decisions, right? And then we have people like you, Apollo, who actually are traditional bankers, and we like to call what is called as banker's instinct, which obviously comes with the credit manager's experience. Where do you draw the line, and how does that do you see them getting blurred? Are they actually getting distinct? What's your take?
Yeah, thank you, Ram. What I would say is that I would view these as complementary. So automated credit decisions and also what we call expert judgment. So as time goes on, we will see more and more automated decisions. But then for a bank to benefit from the benefits of automated credit decisions, they really have to invest in systems. So I think banks that have invested in systems such as CreditQuest have the benefit because they can also collect data points. I think for you to automate, you need the valuable data points. So you cannot do that without investment in a system. So we will see, in my observation in the last few years, perhaps banks that have invested in such systems are approving more than 90% of credits that they are doing, or in a way I could say automated. And these decisions come in a split second, maybe 1 minute decisions. That's what we've observed in Kenya. Yeah, so they may be small ticket size items, but ultimately, yeah, you have the benefit of the volume, speed. So you win from both worlds, so to speak. But then I called it complementary because there are spaces such as corporate where still you will need that expert judgment. So you have your financial analysis where you need an expert to review that and make certain decisions. You'll need review of certain documents, feasibilities and all that to make decisions. So yeah, more and more, the line is being blurred, I can say overall. Thank you.
The line is getting blurred. Thank you, Apollo. And I must, I guess, Tunde, you said it all, right? There is, you did talk about, how data is actually playing a very important role. And, I may actually give it a little bit of a twist. Can we have Tunde on screen, please? I guess if you're not able to see him here. The question to you, Tunde, in your view, what's causing a greater impact, right? Is it, I can't see him here. So why don't I maybe ask, while we're waiting for him, Anuj, I'll come back to you again. So, we talked about how, things have evolved in the last 5 years, right? So if I was to again pose this question to you, Anuj, how has compliance evolved along the way, right? Is there a angle that you see in the way compliance requirements has evolved over the years, particularly with risk supervision becoming increasingly key?
Absolutely, Ram. If we looked at, they've now moved to risk-based supervision. And whereas historically, you had periodic reviews being done. Whereas today, it is an ongoing process. Documents are being submitted on a daily basis. There's regular monitoring. There's evaluation on a risk-based cycle. So things are moving more and more onto a real-time, online and real-time thing. In today's day, people don't have to come to your premises on a daily basis to access all this information. Institutions' risk management systems are being integrated with the regulators. And a lot of these things are now being done offsite. So as we keep moving forward, it will become more efficient. And there's also an ongoing system to identify early warnings. And Tunde said this earlier, a missed covenant or something should be a red flag. And we're seeing this more and more with the regulators as well, where they're able to use these risk-based processes to pick up early warnings that are, when things are going wrong. And nowadays it's less manual and more of the data is being picked up directly from the systems and being transmitted directly to the regulator. So as we move forward, a lot of it is compliance is going to go online, digital, real-time, and risk-based.
And you see them, when you say online, are you seeing them more from the standpoint of the real-timeness, or is it actually also not necessarily being driven by paper, but getting all digital? I mean, what did you imply?
Ram, there's two sides. One is real-time, and number two, it removes the element of, what would I say, manipulation of documents. So, what your system produces is what is being sent. It is not being manually done anymore.
Got it.
Yeah.
Apollo, I think I'll probably go back to the point you were making, right? I mean, you were talking about while, you need to have the manual intervention on corporate decisions, which still requires, the banker instinct, as I call it, whereas the highly voluminous, operations or retail model is about, it's not about value, but about volume, and it is quick and fast and instant decisions. And there is a high degree of speed associated with it, right? Now we have this beast called as SME that sits in between, right? So it's not large corporates, and you have obviously, they're not big enough that it calls for having individual financial analysis, and it's not small enough that you can actually drive it completely, with what you call as automated decisions. And you have this context of what we call as parameter-driven credit decisions, and this whole model evolving there, right? So where do you see this whole picture, right? I mean, do you see this, with increased access to credit data, credit behavior, data analytics? What's your take on credit decisions itself in the way forward here?
Yeah, thanks, Ram. You speak about SME, and I think in this part of the world, we can define that as entities that are employing, say, less than 50 people and turnovers of, say, up to 10 million US dollars. Yeah, that's the sector that is acknowledged to be creating majority of employment year on year. And I think banks are investing and trying as much as possible to support this sector. Now, you need fast decision making. I think one thing that has been identified as the biggest challenge facing this sector is access to finance. Yeah. So for a bank that will invest in these kinds of systems, where you can work out models, parameterized kind of models, yeah, those are the banks that will win this sector, the SME segment. Yeah. Now, what is emerging is that then you'll see more and more investments in this space so that you have also skills. I think one thing that has been lacking is the knowledge and the skill set for people to develop what we call the risk rating models. Yeah. So more and more banks are investing on training and skills where they can in-house develop robust risk rating models that are then fed into the process of decision making, right? So that, in my view, is what you'll see emerging as we go forward. And I think banks also want to give the customer experience, good customer experience to their clients. So they are seeking to deliver on fast turnaround times. So any bank that does not invest in this will fall out because customers will go to the banks where they are getting faster decision making. And that can only happen when you have investments in systems where you can actually develop risk rating models that give you details on the PDs, probability of defaults, loss given defaults, and all that. Yeah.
Got it. No, I think that's a very interesting answer. And in fact, that, brings me to my next question. And Tunde, again, we have Software Group is the sponsor of the event today. And what a very important question I have to ask you in the context of what Apollo just talked about, right? We're talking about models. We're talking about trading the models. We're talking about creating a lot of models, banks investing in models. And I know you just flown in from Canada, and you've been actually dealing with clients in various continents, right? So my question to you today is, how do you see the replicability? These credit models that are being developed by banks. I mean, do you think they are replicable, between banks in the same region or banks across regions? And what does it take for a bank to really actually train the model for its local nuances here?
Thank you, Ram. I was temporarily unavailable. I had some technology challenges, but I'm glad to be back. Now, to answer your question, what we encourage each and every bank to do is to actually use their own data, historical data as the basis for creating their own models. However, as you move from one geography to another, you will see patterns of customer behavior that are uniform. And of course, you learn from one and you go to the other and take advantage of some of the learning that you have had in the previous engagement, to further refine the model that is developed for, subsequent institutions. Yes, there may be some degree of uniformity as you go from one place to another, especially within the same geography. However, the preference is for institutions to use their own historical data, because in each of those data, there are nuances. And unless you use your data, you will not be able to pick up what actually makes your bank different from the next bank and why your customers come to you, for such services. So to answer your question, replicability from one geography to another, to some extent, best practice, and what we recommend is use your own data.
Use your own data. And I think that maybe I have to come back to you, Apollo. Then what does it take for me? What skill sets do you see banks having to be investing in order to actually be able to deliver on what the new ways of, let's say, analytics and portfolio management are likely to be?
Yeah. Thanks once again, Ram. Yeah, truly banks need to review or maybe rethink what kind of skill sets that will be required going forward. So the traditional banker instinct, as you called it, may need to be rejigged. It will not go away entirely, but I think you will be looking at skills such as modeling, for instance. I spoke that people need to be trained in developing these kinds of models that then can be used in decisioning, right? And also another skill set that we'll be looking at more and more is what I call MI and analytics. So you need people who are trained in management information analytics, because that's how you will be monitoring the portfolios going forward, right? And aside from that, you need also to train people more on IT skills, because as you continue to invest more and more in these systems, sometimes there is a disparity that you have too many systems running, but the IT skills are short, So more and more people who have both business acumen and IT skill set, those are the kinds of skills that we'll be looking at going forward.
I mean, yeah, thank you. Have imagined, 20 years back, Anuj and Apollo, when you guys started your banking career, I mean, becoming a credit manager was all about learning financial analysis, right? Now we're talking about, machine learning. And I see a question somebody has posed here that actually goes like this. how effective is machine learning in risk management? Maybe, I mean, we will be taking these questions later, but since this one is very related to the topic, I'll pose that to you, Tunde. You want to answer that?
Absolutely. Thanks, Ram. Obviously, machine learning is a fast emerging field, and it is easy for machines to pick up patterns than for humans to pick up patterns. And today, we're not just talking about data from one system or the other. We're talking about big data, which is massive amount of data. So without machine learning, how do you pick patterns in millions of or hundreds of terabytes or even more of data? So machine learning is extremely important. And as things continue to evolve, I'm sure that
we seem to have disconnection there. Yeah, you're back.
Sorry. Yeah, I'm back. So as things continue to evolve, even artificial intelligence will also find its way in, where some of these information that is gathered from machine learning will be translated into decisions that will be proposed to banks. So yes, machine learning is absolutely important. You need it where you're dealing with massive amount of data. But the first challenge is, how do you get the data?
Yeah.
And you need to start from somewhere. Yeah. And you need the right technology to, capture this data at source. Yeah. And this is where, solutions like credit quest that I talked about comes in, whereby you capture the data at source, number one. Number two, you avoid having the data in different databases, keeping the data in silos. You want to keep them together, where it will be easy for you to derive a good insight.
Got it. Well, I mean, Anuj, as they say, from the days of learning machines, we are now into the days of machine learning. So things have changed a lot. So the $1 million, the $1 billion question to you, Anuj. There has been so much of discussion about, the moratoriums, and once they get lifted, there's going to be a huge credit portfolio challenge for banks around the world, right? I mean, we're talking about billions of dollars that are at stake here. And it's impossible for us not to talk about COVID and its impact. Of the pandemic, even from a credit standpoint.
Ram, like they say, this is the true test of relationship banking. Unfortunately, bankers are very well known for taking the umbrella away the minute it starts raining. So from where I sit, this was the true test of relationships. How did you engage your clients? How did you understand the challenges they're going through? We know businesses go through ups and downs, and you can't only be there for the good times. You must work together through the challenging times as well. And I believe this was the true test of everything we talk about on paper, but, do it limited in reality. So I think this was a true test. But also, as banks, they needed to fast track their digitization agendas, because this has also taught the clients that you should have everything done there and then. So, the banks who were delaying on a lot of initiatives, we will do it. And, I think we did something with Credit Quest not very long ago. And it's something we were procrastinating over for a long time. And suddenly it became a very urgent thing that we need to do it now. So that is what has changed with the banks. And, also we've seen clients becoming more resilient, clients diversifying instead of putting all their eggs into one basket. We've seen sectors really, really badly hit. And, this, from where I see, has become the new norm. If we look at it 18 months ago, we said it's a matter of 3 months. It became 6 months, and 18 months later, we're talking about the same thing. So it is the new norm. So it's how do we all adapt, work together, support one another, and, look at it as a long-term play as opposed to short-term things. Thanks.
No, very well answered, Anuj, and I can't agree more. I think, the people who don't need the money are the ones that bankers chase, as they say, right? So it's always the situation. And I guess these are times when you have to, demonstrate the friend in need is the friend in need. Well, we are now entering, sorry, yes.
Yes, Ram, I was just also going to add to what Anuj has just explained. Now, nowadays, customers have options. There are a lot of non-bank institutions out there that are offering loans to these customers. And they offer this loan at speed. So for a bank to compete, not only do you have to be flexible, you also have to be able to match the speed that some of these non-bank institutions, are able to dispense this loan. And this means that banks need to rethink the entire processes. Correct. Eliminate non-productive processes that are non-value-adding processes that are in the value chain, and ensuring they're able to meet the turnaround time expectation of the customers.
Very true, very true. Well, I mean, what I wanted to do is, we have a number of questions from the audience, and I do want to pose them to our panelists. So, ladies and gentlemen, please keep them coming. We have another 10 minutes where we will be taking questions from the audience. But before we take your questions, you may have to answer the third poll for the day. And then the poll out there is, which of the following, in your view, tops the list? The keyword is topping the list for credit risk management system selection. Is it the functionality, which is a function of the features and modular coverage? Is it the technology, which is about integration and interoperability? Is it market leadership, which means you're looking for past track record and the existing clientele? Or is it the commercials and the contractual flexibility? While the poll is on, Apollo, if you were to make a choice and take a decision, and all of the above is not an answer, unfortunately. You have to pick one. What would you pick as the top of the list?
Thank you, Ram. I would go for functionality, if you ask me. So I've worked with systems such as Credit Quest that has delivered very well for top banks in Africa. So the functionality, I would say, that covers end-to-end credit origination, workflow, financial analysis, risk rating systems, document management. If you have all this in one system, as Tunde said, and the data points then are available in one place, that's what I would go for. I think the other technology can be handled thereafter.
Interesting, interesting. Now, let us see what our audience have to say, Apollo. And I am closing the poll. Well, that's interesting, right? I mean, yeah, functionality is important, but people, because we are moving into a technology-led decision-making era, I guess the audience also believe that integration capabilities and interoperability is relatively more important. And what's very interesting is the total cost of ownership and contractual flexibility is way down the order. Today, that's a hint for you to raise your fee structure, I guess. I'm just kidding. All right. So if we can actually take some questions from the audience, I do see some hands being raised. My request is please do not raise your hands. Pose the questions because it's easier for us to then make sure it's made available to everyone. Avoid anonymous posting. You can quote your name. It becomes easier. There's a question, as a comment from Sheikh Mohammed Ibrahim, who says, thank you, Mr. Tunde, to answer this question. Underlying data used for training data is more critical. And in traditional banks, it's very challenging to upgrade the speed required. I mean, I think all of us agree with that comment, Sheikh. I think that's pretty fair. Now, if we were to actually take this question from Festus, with the advent of machine learning and sophisticated data analytics, does it mean risk managers will be required to be fully grounded in information technology? Tunde, you want to answer that?
Sure. I mean, that's a very interesting question. Do risk managers have to be fully grounded in technology? I do believe that nowadays, everybody needs to be fully grounded in technology. And so whether it is the person that is originating the loan or the analyst or the risk managers, especially because you're dealing with massive amount of data, it's unlikely that you'll be able to think in advance all sort of analytics that you're going to need. So there will be times when you will need to do a different type of analytics or analysis on your data. And you do not want to wait for an expert or an IT department to do that for you. So most of the systems that are available nowadays are flexible, they're intuitive. However, if you do not have that full grasp of technology, you may not be able to do these things on your own. So yes, my recommendation is you don't have to be a programmer. However, you have to be able to use technology that are intuitive and that allows you to be able to do basic reporting and analytics from the system. That way you're not reliant completely on external parties to do that for you. And I'm pleased to say that this is one of the things that you'll find in CreditQuest, because you're able to slice and dice data. It presents you with portfolio data in graphical format, and then you can drill down if required. So yes, that would be my answer to the question.
Sorry, Ram, can I just add a comment on that? We did run some experiments about 2 years ago on exactly the question being asked. And we did use AI and machine learning to review the same credit as well as the credit officer. And, the functionality, the results that came out were 80% aligned. So absolutely, there will be some specialized needs for credit officers, but, for some of the mass market things, in my view, I think AI and machine learning will be able to make a lot of those decisions.
I can't agree more with you, Anuj. I do see some questions that have been posted, and Sheikh Mohammed is actually complimenting you, Anuj, for hitting the nail on the head very hard. So yeah, duly passed on. But I guess there are some questions that are about CreditQuest, and I would encourage them to obviously reach out to Tunde and his team, and they'll be happy to organize for your presentations. There is a question from Bhushan Kelka. Curious to know if banks in East Africa are considering partnering or acquiring fintechs that are specializing in SME financing, which is a segment that is often ignored and underserved. Would you like to take that, Anuj?
Absolutely. So, Bhushan, I would look at it in two ways. Number one, there may be need to acquire, but in today's day and age, you can partner with them. So you don't need to go and compete head on with them. A lot of the products are available in the market. They're off the shelf. You just have to get them customized for yourselves. And absolutely, you are spot on. SME is a sector that's traditionally been neglected by a lot of banks because it has been seen as a high-risk sector. But with the new technologies, new partnerships, what the fintechs are coming up with, they're getting more and more sophisticated. There's some I've worked with, they will come to you with a full package. Here's the customer at the other end, your anchor. Here are the spokes. Here's the platform. Here's the credit insurance. So absolutely, it is going to be something that's going to come more and more. But I don't see it as a need to acquire. It's just a matter of partnering with them.
And I think that's not necessarily true only for East Africa, right? I mean, that's the pattern that you would see, world over. I think that's, and it's an emerging trend. And I think Tunde rightly pointed out that, if you aren't willing to do it, there's someone else who's willing to do it. So you might as well actually participate, right? We have the last, maybe one question, if I may. I think we are closing out on time, but this is one quite interesting from Charles Carey. Whilst I've heard that it's all about relationship banking, the reality is that it's a regulator who determines how banks manage the risk appetite, right? With all the stringent application of IFRS 9 and so on. So how have the bankers on the panel experienced their respective regulators coming to the table and showing some meaningful flexibility in this critical area? Wow, that's going to be a tough one to answer in a public forum, but I don't know who is going to answer that. Maybe Tunde, you want to take that and say how can banks engage constructively with regulators in demonstrating what could actually be the emerging flexibility required in dealing with relationship banking? Yeah.
Thanks, Ram. I've got my opinion on this, but I would rather let's get some of the bankers to go first.
Why not? Sure, of course.
And then I can, sure.
I was trying to be apolitical, but I guess the bankers.
Yeah. Okay. So maybe I can take it first.
Sure.
Yeah. So what I've observed is that many of the banks are ahead of the curve, or some of the banks in the market will be ahead of the curve as compared to the regulator. So there will be need for a lot of collaboration in that sense, working with the regulator, and for the banks who have developed these kinds of systems, these kinds of processes, to go to the regulator, because ultimately you need approval from that level. And that's the mismatch sometimes. If there is no understanding in both ways, then there'll be a lot of delay in the approvals that you sought, that you're seeking from the regulator in this respect. So for instance, if I can say the experience that I saw in Kenya in some banks who are quite advanced on the digital products, some of them have had to partner with telcos, for instance, in rolling out those products. Yeah, sometimes it takes quite some bit of time if the regulator does not understand or is also not so much invested in the knowledge in such types of products, for example. Yeah, so it needs collaboration ultimately from both ends for it to work well. Thank you.
So, I mean, what I'm essentially taking away here, Apollo, is that you will have to invest in educating the regulator if you really want a meaningful approval process from them. I think that's, can't be, I mean, I completely agree with you on that, Apollo. Anuj, would you agree?
Yes, I would. And, what we've seen, especially in Kenya, the regulator has been quite open-minded. There has been a lot of dialogue taking place. And, when things were rough, they did give the bank a bit of leeway. And even after that, there's a lot of engagement that goes on between the Kenya bankers and the central bank. But having said that, at such a time during COVID, there is an expectation of heightened NPLs, and there's no running away from it. But, this is where banks have to make that difficult choice. Are you going to work with your client knowing that they're a non-performing account, knowing that they're affecting your ratios, knowing that this could create a perception in the external world, as opposed to saying, let me take the drastic decisions now just to manage my books. So this is where I keep saying there has to be that relationship banking that banks need to be moving towards.
And I'm gonna add to that. I mean, there is an active conversation going on now by experts about innovation and regulation. Which one should come first? And we have seen in different geographies, central banks that have decided that they would not stand in the way of innovation, but they will be ready to catch up very quickly with regulation. And those markets tend to be very virile, very active. There's a lot going on. We've also seen markets wherein you cannot do anything without regulation. And of course, we've seen that in that market, things are very slow to move. Correct. Because the regulator wants to approve. So really, from my perspective, there are no right answers here. Yeah. I think it's engagement with the regulator, educating the regulator, and actually showing them how would you manage the risk. That is extremely important. How would you manage?
Engaging, educating, and it's about managing relationships. Very well said.
Absolutely. Yeah.
Thank you, Tunde. I think we've pretty much come to the end of the session, but I do want to make sure that we have one for the road, as they say. So I am going to pose the last question here. And this one is, I would love the audience to poll on this before we close for the session today. After listening to all of the last 1 hour's discussion, right, which of the following would you rate as the most critical change driver that credit risk managers need to deal with? Is it the evolving global, regional regulatory compliance needs? Is it the emerging client needs and resultant expectations? Is it about process changes driven by data and analytics? Or is it actually adapting with the emerging tools and technology and reskilling of people, right? Well, unfortunately, as I said before, all of the above, although we all like to choose that, is not an option, and you have to make a choice. And we will, as I could see, the polls are actually, it's a pretty tight poll, as I can see from what I see on the screen here. I am going to close the poll in the next 10 seconds. So, okay, I close the poll now. And before I publish the results, let's see what the panelists have to think as the right answer. Tunde, what would you think is the answer or the most popular answer?
Actually, it's all of the above is the answer.
I can't disagree there. Well, the answer is indeed about the process changes, or it's the most popular answer, driven by data and analytics. And the second one is actually about skilling, right? Not so much about compliance or about, aligning with expectations, which can all happen if we got the data analytics and decision-making processes in place. Well, on that note, if I may, unfortunately, all good things have to come to an end. And this was highly engaging, hopefully very useful to the audience. And I must say it was very enlightening for me personally. So thank you, Polo, thank you, Anuj, and thank you, Tunde. Once again, thank you for sponsoring this. And thank you for the time that all the panelists have put together here. And if the audience do have more questions, you're welcome to write to us, and we'll have it respectively passed down to the panelists here. Wish you all a great evening, and thank you.